Welcome back to We Are Cosmic, the channel where we break down what's really happening behind the numbers in crypto and global markets. Today's discussion is focused on XRP, the broader cryptocurrency market, and the key macro events that are shaping price action right now. The market may look quiet and frustrating on the surface, but historically, these are exactly the moments that deserve the most attention. Right now, crypto feels stuck. Prices move up slightly, then pull back again, creating a sense of uncertainty across the market. XRP is currently trading around the low $2 range, slightly lower on the day, and this mirrors what we're seeing across most major cryptocurrencies. The top 100 assets are mostly in red, not because of any major breaking news, but because the market is reacting to anticipation, not headlines. That distinction is important. This kind of choppy sideways movement is not random. It tends to happen when markets are waiting for a catalyst. Traders are hesitant to take aggressive positions, liquidity slows down, and both buyers and sellers step back. From a historical perspective, these conditions usually appear before major moves, not after them. That doesn't mean an immediate breakout is guaranteed, but it does explain why volatility compresses during periods like this. When we look at technical data across the market, many indicators show weakness. Several moving averages remain in negative territory, including on XRP. These technical zones often signal exhaustion rather than collapse. Historically, when assets sit in these areas for extended periods, the probability of a strong reaction increases. Again, this is not about predicting exact timing, but understanding market structure. One of the biggest reasons the market is cautious right now is the upcoming Federal Reserve meeting. This week is widely seen as critical, with expectations centered around a potential shift in interest rate policy. As we approach major Fed decisions, markets often pull back slightly, especially early in the week, as participants reduce risk. This pattern has repeated many times in the past, and crypto markets are especially sensitive to it because they are classified as risk assets. Another factor adding pressure is global macro uncertainty, particularly coming out of Japan. Discussions around the Japanese carry trade and possible interest rate changes are influencing risk sentiment worldwide. For years, capital from low-interest environments flowed into higher-risk assets like crypto. Any signal that this dynamic could reverse tends to weigh heavily on digital assets first, even before stocks react. Despite this short-term pressure, long-term structural developments continue quietly in the background. Regulatory conversations in the United States are becoming more consistent, more organized, and more forward-looking. Statements around bringing markets on-chain and expanding regulated crypto infrastructure point towards structural integration rather than restriction. These changes don't impact price overnight, but they reshape the market over time. Volume data tells a similar story. Overall, market volume remains lower than average, which confirms hesitation. However, XRP's relative volume has shown resilience compared to other assets. This suggests continued interest even while broader participation declines. When volume contracts during consolidation, it typically signals energy building, not disappearing. Markets rarely move in straight lines. Long consolidation phases are normal, even frustrating, but they are an essential part of how trends develop. Many of the strongest moves in crypto history began after periods that felt exactly like this. Slow, boring, and emotionally draining. Understanding that pattern helps remove emotion from analysis. To understand what XRP is doing right now, it's important to zoom out and look at how it has behaved during similar phases in the past. Short-term price action can be misleading, especially in periods where macro uncertainty dominates headlines. XRP, like most large-cap crypto assets, moves in cycles that are closely tied to liquidity conditions, market confidence, and broader risk sentiment. At current levels, XRP has been consolidating in a relatively tight range. This phase has lasted longer than many expected, which naturally creates frustration. However, consolidation itself is not a sign of weakness. In market structure terms, it represents balance. Buyers and sellers are temporarily in agreement, waiting for new information strong enough to tilt that balance in one direction. Historically, XRP has spent long periods moving sideways before making sharp directional moves. Previous cycles show that when XRP compresses volatility near key support zones, it often leads to sudden expansions in price. These expansions do not always last immediately, but they tend to reset the market into a new structural range. The key detail here is that XRP rarely gives long advanced signals before those transitions occur. Another important element is relative performance. While many smaller and more speculative tokens have seen significant declines in both price and volume, XRP has shown relative stability. This does not mean it is immune to market pressure, but it does suggest that participants are treating it differently than high-risk assets. In risk-off environments, capital tends to rotate out of speculative positions first, while assets perceived as structurally important hold value more effectively. From a technical perspective, XRP is currently trading near zones that have previously acted as long-term accumulation ranges. These are areas where price historically slowed down, volume stabilized, and long-term holders increased activity. Again, this does not define the exact timing of a move, but it does help explain why price is not collapsing despite negative sentiment. Volume behavior adds another layer to this picture. While total market volume has declined, XRP's activity has remained comparatively elevated. This divergence is important because falling volume across the market usually reflects indecision. When an asset maintains engagement during these periods, it often means participants are positioning quietly rather than exiting entirely. Market psychology plays a massive role here. Long consolidation periods tend to push participants toward emotional decisions. Optimism fades, attention drops, and confidence erodes not because fundamentals change, but because time passes without visible progress. This is a normal part of every market cycle and has repeated across crypto equities and commodities for decades. XRP's position within the broader crypto ecosystem also matters. It is closely tied to discussions around regulation, institutional usage, and infrastructure development. Because of that, its price often reacts more strongly to policy signals and macro developments than meme-driven or purely narrative-based assets. This can make short-term movement feel slower, but it also makes market reactions more deliberate. It's also important to recognize that XRP does not move in isolation. Bitcoin dominance, liquidity flows, and stablecoin activity all influence its behavior. When Bitcoin consolidates and liquidity tightens, altcoins often pause. XRP's current behavior fits cleanly within that wider pattern. Another key point is time compression. Markets tend to spend much more time consolidating than they do expanding. The moves that people remember often happen quickly, but they are built over weeks or months of quiet price action. This current phase in XRP reflects that build-up process, even if it feels uneventful. Crypto assets, including XRP, are highly sensitive to global liquidity conditions. Unlike traditional markets, crypto tends to react earlier and more aggressively to changes in monetary policy expectations. That is exactly what we are seeing right now. This week's Federal Reserve meeting is a major focal point. Markets are currently pricing in a strong probability of an interest rate reduction, but expectations alone do not remove uncertainty. Until the Fed formally communicates its decision and forward guidance, participants remain hesitant. This hesitation often results in sideways price action, reduced volume, and short-lived volatility rather than strong trends. Historically, the days leading up to Federal Reserve meetings show a similar pattern. Risk-heavy markets often experience early week pullbacks as traders reduce exposure. This happens not because participants expect bad news, but because unexpected outcomes carry asymmetric risk. Once the Fed decision is out and markets digest the information, volatility usually returns in a clearer direction. For crypto, this effect is amplified. Digital assets are priced forward, meaning they respond to future expectations more than current conditions. When liquidity may improve, markets pause and wait. When liquidity becomes restrictive, crypto often sells off faster than equities. This makes crypto an early signal rather than a lagging one. Another key factor is duration. Unlike prior Fed communication cycles, there was a long gap between policy updates. When guidance stretches out over months, markets overanalyze every signal. Now that policy clarity is returning, price discovery is temporarily slow as markets recalibrate expectations rather than react emotionally. Liquidity also impacts leverage. When interest rates are high, leverage positions become more expensive. This reduces speculative activity and compresses volatility. XRP's current tighter price range reflects this reduced leverage environment. When liquidity conditions eventually ease, the same compression often leads to faster expansions. Beyond interest rates themselves, forward guidance is just as important. What the Fed says about inflation, economic resilience, and future policy direction will influence how long markets remain cautious. Crypto listens closely to these signals because future liquidity availability defines risk appetite. It is also worth noting that crypto requires fresh capital inflows to sustain major moves. During uncertainty, capital waits. Once uncertainty resolves, capital reallocates quickly. That reallocation is often more dramatic in crypto because the market is smaller, more reactive, and more globally connected than traditional equity markets. This is why short-term price fluctuations around macro events should be viewed as positioning behavior, not trend confirmation. A lack of movement before key decisions does not imply a lack of interest. It suggests restraint. While the Federal Reserve dominates market attention in the short term, it is not acting alone. Global monetary dynamics, especially in Asia, also play a critical role. In the next part, we'll examine Japan, the carry trade, and why shifts there disproportionately affect crypto markets, sometimes more than U.S. policy itself. While the Federal Reserve often dominates global market attention, recent price action in crypto cannot be fully explained without looking at Japan. For years, Japan has played a quiet but critical role in global liquidity through its extremely low interest rate environment. That environment helped support risk-taking across global markets, including cryptocurrencies. The concept at the center of this discussion is the carry trade. In simple terms, capital is borrowed in a low interest rate environment and deployed into higher yielding or higher risk assets elsewhere. For a long time, Japan provided one of the cheapest sources of capital in the world. When interest rates were near zero or even negative, it made sense for investors to move funds into assets with higher potential returns. Crypto became one of those destinations. The appeal was clear: high volatility, global access, and large upside potential. As long as borrowing remained cheap and stable, this dynamic supported speculative behavior. However, when signs emerge that this environment could change, capital becomes cautious. Recently, discussions around Japan potentially adjusting interest rate policy have added stress to global markets. Even the possibility of higher rates can force funds to reconsider risk exposure. This does not require actual policy changes to begin affecting markets. Anticipation alone is often enough. Crypto, as a risk asset, feels this pressure faster than most markets. Capital tends to exit high volatility positions first. This is why digital assets often react more sharply than equities when liquidity concerns arise. The stock market may remain relatively stable in early stages, while crypto absorbs the initial adjustment. What makes this particularly relevant is that some of the capital that flowed into crypto during low-rate periods is now more sensitive to policy changes. When risk needs to be reduced quickly, crypto offers liquidity and flexibility, making it one of the first assets to be trimmed. This dynamic also explains why certain segments of the crypto market have been hit harder than others. Highly speculative tokens tend to experience sharper declines because they were often the primary vehicles for high-risk allocation. Assets tied more closely to infrastructure, regulation, or long-term utility tend to hold better in comparison. XRP fits more into the second category. While it is still affected by broader risk sentiment, it is less exposed than purely speculative assets. This helps explain why, despite market pressure, XRP has not seen the same magnitude of decline as some high-volatility sectors. It is also important to recognize that these adjustments are not permanent exits. Carry trade dynamics shift rather than disappear. Capital moves out during uncertainty, but frequently returns when conditions stabilize. Markets do not need perfect clarity, they need predictability. Once participants can model future conditions with confidence, risk appetite often returns. Another key point is the timeline. Japan-related adjustments unfold gradually, not overnight. Markets may remain sensitive for weeks or months as expectations evolve. During this time, crypto tends to remain choppy rather than trend decisively. This helps explain why current price action feels uncomfortable, but not destructive. The market is recalibrating rather than collapsing. Liquidity is repositioning rather than evaporating. This is an area where XRP occupies a unique place within the crypto market, and it helps explain why interest remains even during broader market weakness. Over the last year, regulatory dialogue in the United States has shifted noticeably. The conversation has moved away from uncertainty and enforcement-driven narratives toward framework building and market integration. This change does not immediately impact price, but it significantly alters how institutions assess risk over longer time horizons. One of the most important developments is the growing discussion around regulated on-chain markets. Public statements pointing toward placing traditional financial infrastructure on blockchain rails represent a philosophical shift. Instead of resisting digital assets, regulators are increasingly focused on how to structure them within existing systems. For the crypto market, this transition matters deeply. Institutional capital does not enter markets that lack regulatory clarity. It waits for defined rules, predictable enforcement, and compliance pathways. As these elements become clearer, the nature of market participation evolves from speculative to structural. XRP has long been positioned at the intersection of crypto and traditional finance. Regardless of short-term sentiment, its narrative is tied to payments, settlements, and financial infrastructure rather than purely speculative use cases. This means it responds differently to regulatory signals than assets driven mainly by hype cycles. Recent discussions surrounding regulated crypto spot markets also reinforce this shift. The creation of formal market structures allows institutions to engage without taking on undefined legal risk. This does not necessarily cause immediate inflows, but it builds the foundation for sustained participation over time. Institutional involvement tends to be slow, deliberate, and patient. Unlike retail-driven rallies, these participants accumulate during periods of low volatility and disengaged sentiment. That accumulation often happens quietly, without dramatic price spikes, which can make market behavior appear unexciting in the short term. Another important factor is compliance alignment. Assets perceived as compatible with future regulatory frameworks tend to benefit from relative stability during uncertain periods. This does not make them immune to drawdowns, but it changes their risk profile compared to assets operating entirely outside institutional standards. XRP also benefits from enterprise-level development that continues regardless of daily price movement. Infrastructure does not pause because the market consolidates. Partnerships, system upgrades, and long-term integrations move forward in the background even while charts remain flat. This separation between price and progress often creates confusion. Markets frequently undervalue developments that do not produce immediate speculative returns. Over time, however, these developments shape how assets are classified, traded, and adopted. During macro stress, capital prioritizes assets with clearer long-term narratives. While speculative capital exits, structural capital tends to wait rather than flee. This creates a stabilizing effect, even if price advances take time. As the market moves forward, regulatory clarity and institutional engagement will increasingly determine which assets benefit most from renewed liquidity cycles. XRP's positioning within those discussions makes it an asset that participants watch closely even when momentum is muted. When all the pieces are put together, the current crypto environment becomes much clearer. The market is not reacting to a single event, but to a convergence of forces: macro uncertainty, tightening liquidity, regulatory transition, and shifting global capital flows. None of these elements operate in isolation, and together they explain why price action feels slow, frustrating, and emotionally draining. Market psychology plays a critical role during phases like this. Extended consolidation has a way of wearing down participation. Optimism fades, interest declines, and confidence slowly erodes. Importantly, this happens without dramatic price crashes. Instead, boredom and fatigue do the work. Historically, these psychological conditions often appear near structural turning points. Markets rarely allow the largest number of participants to feel comfortable at the same time. When sentiment is strong, risk increases. When sentiment collapses, opportunity begins to form. That does not mean prices need to reverse immediately, but it does mean the balance between risk and reward starts to shift quietly. Consolidation phases are essential to how markets function. They absorb excess speculation, reset leverage, and allow long-term participants to reposition without chasing momentum. While price remains range-bound, structural developments continue underneath the surface. Over time, these forces align and release energy back into the market. Crypto has followed this pattern repeatedly. Bitcoin, Ethereum, and XRP have all experienced long periods of compression before sharp directional moves. These moves tend to happen quickly and feel obvious only in hindsight. Before they occur, the market usually feels uncertain, divided, and uninspiring. XRP's current behavior fits this historical rhythm. It has absorbed macro pressure without experiencing structural breakdown. Volume has cooled, volatility has compressed, and sentiment has softened. These are not signs of a broken market. They are characteristics of one that is resetting. Macro catalysts, such as central bank decisions, often act as timing mechanisms rather than root causes. They accelerate changes that were already building. Whether the next move comes immediately or after further consolidation, markets tend to shift once uncertainty peaks rather than when clarity feels comfortable. Another important element is time horizon. Short-term price fluctuations dominate attention, but long-term structure determines outcomes. When focus stays locked on daily candles, it becomes harder to recognize broader transitions. Stepping back allows patterns to emerge more clearly. This is why periods like this test discipline more than conviction. Price does not provide constant feedback, and narratives lose energy. Yet historically, this is how markets prepare for their next phase. No market moves endlessly in one direction. Expansion follows compression. Volatility returns after stillness. This is not unique to crypto. It is a core property of all financial systems. The current environment reflects that natural cycle rather than an anomaly. As conditions evolve, attention will gradually shift from uncertainty to opportunity, from hesitation to positioning. By the time sentiment fully changes, price usually has already moved. Understanding that sequence helps explain why market turns often feel sudden, even though they were built slowly. We'll continue tracking these macro signals, liquidity shifts, and structural developments here on We Are Cosmic, breaking down complexity into clear, understandable analysis without hype and without noise. If you found value in this breakdown, stay tuned for more deep dives into how crypto markets really operate beneath the surface.